The government just made a major change to one of the biggest tax benefits for Australian property investors. And if you're thinking about buying an investment property, or you already own one, you need to understand exactly what's changed and whether this affects you. I'm Ryan from Reinvested. I make finance content for everyday Australians who want to build wealth without a finance degree. So let's get into it. First, what is negative gearing and why does it matter? Negative gearing is when the costs of owning an investment property, being a mortgage, interest, council rates, maintenance, or property management fees, are higher than the rental income that you receive. So your property is essentially running at a loss. Under the old rules, you could take that loss and deduct it from your other income, like your salary, which meant that you paid less in income tax. Here's a simple example. Say your investment property costs you $30,000 a year to hold, but only brings in $22,000 in rent. That's an $8,000 loss. You could deduct that $8,000 from your salary and pay tax on $8,000 less income. For someone on a high marginal tax rate, that could save thousands of dollars a year in tax. And that's been the rule in Australia for decades. It's a big reason why so many Australians have invested in property. So what's changed? In the 2026 federal budget, the government announced that negative gearing on established residential investment properties will be abolished from 1 July 27, but only for properties purchased after 7:30 p.m. on the 12th of May. That was budget night almost 2 weeks ago. If you already own an investment property or you were under contract before that date, nothing changes for you. You are fully grandfathered under the old rules and your negative gearing benefits are locked in until you sell. But if you buy an established residential property from now on, you will not be able to use negative gearing to reduce your salary income. You can still carry forward the losses. They don't disappear, but they can only be used to offset the rental income or capital gains from that property in the future, not your wage. There is one important exception. New builds are completely exempt from this change. If you buy a brand new property, negative gearing still applies as it did before. The government does want people to purchase new builds, e.g. encourage new construction. So they've kept the tax benefit only for new builds. Now, here's the part that's already hitting people. The banks have already started adjusting. When a bank assesses how much you can borrow to buy an investment property, they take negative gearing into account. The tax saving from negative gearing improved your cash flow on paper, which meant that you could realistically borrow more. Remove that tax benefit and your effective borrowing capacity drops. The Commonwealth Bank has estimated that removing negative gearing is equivalent to a 90 to 155 basis point increase in effective borrowing costs for investors. That's similar to 1 or 2 full interest rate hikes on top of the 4 that we've already had. So not only is the tax benefit gone, the amount that you can borrow to buy an investment property has actually shrunk. So what does this all mean for you? If you already own an investment property, you're protected. Keep doing what you're doing. Make sure your records are in order because the CGT changes coming in 2027 will matter more to you. If you were planning to buy an investment property, the numbers have changed. The cash flow assumptions you might have been running on no longer apply for established properties. You will need to recalculate your position without the negative gearing benefit. If you're considering a new tax bill, the situation is unchanged. New builds are exempt. This might push more investors towards new construction, which is exactly what the government wants. And if you're just a first home buyer and you're wondering whether this helps you, maybe slightly. With fewer investors competing for established properties, there could be less pressure on prices, especially for existing homes. CBA is forecasting house prices to be about 3% lower than they otherwise would have been as a result of these changes. 3% is not enormous, but in a market where affordability is already stretched, every little bit matters. The bottom line is this: the rules around property investing in Australia have fundamentally changed in the last 2 weeks. If you're making any decisions around investment property, you need to understand the new landscape before you act. As always, nothing in this video is financial or tax advice. Speak to a qualified financial advisor or tax agent about your specific situation. If this was useful, subscribe because I'm covering all of the major financial changes affecting Australians every week. I'll see you in the next video.